Thanks for listening to The Derivative. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.
Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world.
So, and then you say, well, do hedge funds return? And then you say, well, what is it? What sort of risks are they really being exposed to? Are they long? A lot of hedge funds are still running long market. And if market crashes, they do badly. They're stressed a little bit, I think, because the ones that generate good returns in a sort of uncorrelated way, if the equity markets are really doing well, they underperform, even if their kind of return quality is different, right? So then their investors look at them and say, well, how come S&P was up 20% last year and you were up 8%? And they sort of feel, well, maybe I should take some market risk and sort of smooth it out. And so then have this weird thing happening.
Hello and welcome back to The Derivative. I'm your host, Jeff Malik, and looking forward to a bit of a hedge fund three-way here tonight with a manager, a quant analyst investor, and founder of a disruptive multi-strat hedge fund-to-fund /overlay/platform that has brought them all together. Our three guests hail from across the world, and we're excited to get into the nitty-gritty about quant strategies, hedge funds, fintech, and the future of our industry. So welcome, guys.
Thanks for having us.
Thanks for having us.
Thanks for being here. Yeah, so some quick introductions. Joining us today, we have Max Nissman, co-founder and managing member of a short-term systematic trading shop, Linnis. We have Scott Treloar, co-founder of Noviscient. Say that again for me, Scott.
Yeah, Noviscient. Correct. So you're pretty close.
Noviscient. We just know that I failed in the first 2 minutes. So co-founder of Noviscient, and Olivier Dacier, head of applied research at APAC. So thanks for joining us all over the world, guys. We have Max in California and the rest of you are in Singapore. Is that correct?
Yes.
Correct.
But not together, right?
Together, but
no. Olivier's in the boardroom, I think.
Got it. So Scott, I kind of wanted to start with you and have you set the scene, if you would, and lay out how and why the three of you ended up on a podcast together. Kind of the quick origin story for how you three fit together without going into too much of the nitty-gritty of your project, but set the scene for us if you could.
Yeah, so I used to work, I was a sort of portfolio manager and chief risk officer for a fund here in Singapore. We were out trying to raise capital and we found it, extraordinarily difficult. We figured that we could generate sort of better returns, but capital was very hard to get, particularly from the big pools of capital, endowment funds, even the very large family offices. It was sort of flowing more towards safety, towards brand name funds, towards the big houses. And they have a sort of role, but the interesting returns are coming from the smaller managers. So the challenge was, how do you actually open up the pipeline between smaller managers and the bigger pools of capital? Excuse me. And sort of technology is a natural way to do that. So a platform that allows boutique managers that could be managing anywhere between 20 up to, really up to $500 million in capital, allows these managers to connect to a platform using APIs. We can then select dynamically which of these strategies are generating alpha at the time, put them together dynamically, in other words, a sort of dynamic portfolio allocation to build custom products for investors. So what we're really trying to do is to bring this industry, which to our minds, to my mind, is still operating as if it was the 20th century, right, with spreadsheets and PDF reporting and poor alignment, bring it sort of online and into the 20th century. So having this sort of dynamic connection to groups like Max, where instead of a sort of standard fund of funds, we take capital and we give it out, which means the same due diligence processes have to happen regardless. We have to do due diligence on 20 of our small managers. We flip it, so we take the signals in. And what that means is, what's relevant for us is the ability of Max, people like Max, to generate alpha signals. We can then get them executed and constructed into alpha portfolios. But we sort of start to reduce the whole due diligence process. It doesn't take us 2 years to make a decision. We can run real-time risk management online. So that's the sort of bringing the industry into the 21st century. And so we kind of have investors. So Olivier is both an investor into the firm, but also an investor into the fund. And Max is one of our sort of, really interesting alpha partners in that, his Linnis strategy generates alpha, but it's also uncorrelated to broader markets, to other strategy classes, even negatively correlated, even tends to outperform in periods of stress. So we're trying to construct alpha solutions for medium to sort of bigger investor pools by dynamically combining all these sort of interesting managers like Max.
And so you're sort of the glue here of said, hey, I want to build something where I can get big money access to these niche managers. Max is one of those niche managers. And then Olivier said, hey, I really like what you're doing. I want a part of that, both as a kind of an angel investor in the company itself, and then also as an investor in these end strategies.
Yes, correct. Absolutely.
Fair way to sum it up?
Yeah, and sort of
awesome.
using platforms and some smart machine learning to do that, right? Starting to work in with technologies and APIs and connectivity and that sort of thing that exists now and exists in other industries, just not so much in finance yet.
Yeah, and we'll dig into that a bit. So with that scene set, let me get into some of the quick bios here. So Max, I'll bring it over to you. First, let's talk about your hat. What do you got going on there?
Well, it's kind of double meaning. I mean, I love math. That's what I studied. That's what I use every day. But also,
and for those not seeing us on YouTube, he's got the just a black baseball cap with MATH, math, and in bold letters on top.
Yeah, and then it's also it was Andrew Yang, one of the Democratic candidates. I liked his approach, kind of science, numbers based. A technocrat might be something that'd be interesting to have in office, but he was a far way off. But I just love the slogan, "Make America Think Harder."
Yeah. Wait, what was it? What was his pen? Math.
So the math stands for "Make America Think Harder."
Ah, okay.
Yeah.
And then so it's a double meaning.
Yeah.
And then you said you're out in California right now?
Yeah, it's first trip since the lockdown in NYC in mid-March. So we're based out in New York. I typically travel a lot, but yeah, this is the first trip I came back to see my family. I hadn't seen them for a while.
Got it. And then what's your so before you were at Linnis, what was the quick background?
Yeah, I met my business partner G Lin at BlackRock in 2010. We were both portfolio managers. He was running a very early form of what we were doing in cash US treasuries. And we kind of hooked up and started thinking about ways to take it into a incentive fee-based product internally, externally. We didn't get started until 2014. It was pretty early in our careers. Prior to that, at BlackRock, and prior to that, I was doing mortgage-backed securities. So I had started at Merrill Lynch in January of 2008 in mortgage-backed securities research.
Ah, great timing.
Yeah, I'm a good market timer. Mortgage-backed securities 2008, managed futures 2014. So my next move, maybe do the opposite. Yeah, so it was at the time before the crash. It was one of the kind of hottest quant products with copula pricing and all this kind of exotic pricing that was being done to price CDOs and mortgage-backed securities, et cetera. It was interesting when I had gotten out of my graduate school program in math, but it quickly became pretty much a distressed credit product where I was reading prospectuses all day and not really doing a whole lot of math. So in 2010, when I met G and he was working on a quant strategy and I was still doing mortgages, I just kind of quickly saw the value in what he was doing and appealed to me because it really went back to my roots in education.
I love it. So Olivier, let's bring you into the conversation here. Let's give us some quick background, what you're doing now.
So, well, I started as an investment banker, actually, for the first 9 years. Every company I've worked at has been bought by someone, right? So I've had a similar kind of luck. So I started working for Smith Newcourt. I don't know if some of you may remember, there was a British market maker. It got acquired by Merrill Lynch, and then I worked at Nikko Securities. It got acquired by Citigroup, and then I worked at Barra for 7 years, got acquired by Morgan Stanley. And then I worked at AXIOMA for the last 14 years. And last year we were acquired by the Deutsche Börse Group and merged with their stocks and DAX indices business into what we call Contigo. So I had applied research for Asia Pac at Contigo. And I've been, in the quant field all my life, basically.
And Contigo, any relation to the water bottle that we see all over the U.S.?
No, I guess not. No, it's Contigo with a Q, actually.
Yeah, and no relation to Contango in the futures markets.
That's right. Contigo is
so,
only from the Spanish word together, since it's three companies together in one.
I like it. And so your quant background, what does that look like? Hardcore programming or on the applied math side?
No, I see the programming. That's where you lost me, because when I studied, I had COBOL and Lotus 1-2-3. I didn't even have Excel yet when I went to college. So all my coding, practice was useless. It's become obsolete. I've learned all of my coding on things that don't exist anymore. It's like being Atari champion. What's that do for you today?
Right. My wife works for Blue Cross here in Chicago, and they finally figured out they needed a new system to run the database of the claims, because the guy who knew how to run the legacy system started coming into the office with an oxygen tank. And they're like, all right, we need to move off. I don't remember if it was Lotus or one of those, but there was key man risk there for sure. Great. And then, so Olivier, how did you get tied up with Scott, and what interested you in some of what he was doing?
So the interest came from two different reasons. I mean, the first is I work in financial services and the capital markets, so my income is highly correlated with capital market, and therefore I'd like to find an uncorrelated source of return for to invest my savings. Otherwise, I'm just doubling up on the same bet. So talking with Scott over the years, for the last 2 years, and hearing about what he's doing, I thought that was great, because looking for the needle in the haystack by myself, I have a full-time job, so finding people like Max from Singapore with a full-time job is very, very difficult. So the ability of Noviscient to find these needles for me, and instead of me finding one needle every 2 years, I can just simply buy the box of needles straight from Scott. That was an instant appeal for me.
It's always amazing to me how few people in finance understand that concept, that they're double or even quadruple leverage.
Yeah.
Right.
And I have a lot of friends in the industry that think the same way.
Their fee. Yeah, it's crazy, because they've got their fee revenue, they've got then their personal exposure, their clients' exposure. So they've got way more exposure than they think.
That's right.
Let's get into just the hedge fund space in general a little bit. We just put out a blog post a little while ago asking the question, do hedge funds suck? Sort of tongue in cheek, but when you look at the stats, and of the HFR indices and whatnot, they lost a little bit less in March and April when the market was crashing, but in 19 they made significantly less than the upside. So it seems if you're just a novice investor saying, hey, I want to get into these hedge funds, they look like they make 15% of the upside and capture 80% of the downside, there's not a whole lot to like there. What are you guys' overall thoughts on that picture of hedge funds?
I know Max has some ideas on this. Let me jump in first. I mean, I think even this idea of hedge fund, I don't know what that word means, right? Is it a sort of unconstrained investing style? Is it a way to transfer wealth from investors to hedge fund owners, that sort of thing? So, and then you say, well, do hedge funds return? And then you say, well, what is it? What sort of risks are they really being exposed to? Are they long? A lot of hedge funds are still running long market, and if market crashes, they do badly. They're stressed a little bit, I think, because the ones that generate good returns in a sort of uncorrelated way, if the equity markets are really doing well, they underperform, even if their kind of return quality is different, right? So then their investors look at them and say, well, how come S&P was up 20% last year and you were up 8%? And they sort of feel, well, maybe I should take some market risk and sort of smooth it out. And so then have this weird thing happening. There's a guy, Besson Binder, who wrote some stuff about how do you have, if you go and talk to hedge funds, say, show me your high conviction trades, and you look at the performance of those high conviction trades, they actually do quite well. There's alpha there. But what they've also added to smooth everything out is all these sort of low conviction trades, which strip all the alpha away. And what you're left with is sort of, negligible performance. And they've sort of done that because investors are still kind of return centric, right? Their ability, and it's a broad generalization for investors, but it's not really untrue. Investors think about returns, but they don't often, even in quite sophisticated places, get down to the depth of, okay, what's the sort of quality of returns? What's the sort of risk exposure that I'm having for that return stream? And so from our point of view, we try to think about, well, there's three categories of return. There's return to cash, time value of money. There's return to exposure to various risk premia. And then there's mispricings and dislocations, which is alpha. And any sensible investor, and slowly the really leading edge pension funds are starting to kind of come up towards this kind of more structured factor-based approach. But right now it just feels that we're in the midst of just weirdly enormous confusion about what is a hedge fund, what is alpha, what is beta, what is excess return, what is risk, what does it all mean, which is weird, but reality.
Yeah, but I think to my point is you can look at it across different hedge fund categories, and it's sort of across the board, and there's a bunch of issues with that, right? You're taking the average, you're not taking the best, you're realizing a lot of the worst when looking at those indices. So yeah, we're all proponents of it. We all are drinking the Kool-Aid, but I'm just, in your dealings with investors, are they believing in the world of hedge funds or not?
I mean,
I understand what you're saying. It comes back to what is that word even?
Yeah. So the average is the problem, right? This stream that I want to cross is only 2 feet deep on average, but halfway across, it's 12 feet deep, and I sort of drown because on average it's 2 feet. But so averages kind of cover a lot of sins. Investors, I think they're getting desperate, right? It feels like, they are sort of what we might call gambling for redemption, or sort of punting, almost lottery-like, right? We know that bond yields are very low. We know equity markets look precariously high given, the potential shocks and events, Max's events that exist. And so they sort of say, well, I just hope I can find some good hedge funds that work. So let me clarify that. Hedge funds on average are going to, I think there's just too much money going to the very big funds, and the very big funds cannot deliver any excess returns because they become the market essentially, right? So, this channeling of funds of, hedge funds, 3.5 trillion, maybe 3 trillion now, 80%, 90% head towards the very big funds who just deliver some sort of more market-like return. And then the more interesting funds, the $500 billion of boutique funds that can deliver the excess returns, are a bit hard to find. They can deliver if you can select them, if you can find them, if you can get access to them. We see that in our results. On average, it looks terrible. So you need help. That's the sales pitch a
Yeah,
little bit.
agreed.
But I think
Max, what are your thoughts?
Yeah, I'm pretty cynical about the industry. I think it's pretty much fundamentally broken for probably a number of reasons. I don't think incentives are correctly aligned. At the end of the day, everybody just wants to keep their job. So not naming names, but there's a lot of people who you could give all your money to, and they haven't done well. I don't think that they're going to do well in the future, but you probably won't get fired for it. I think post-financial crisis, with a lot of the fraud was uncovered, some of the big stuff out there, I think, people are shying away from the small managers. They're just a due diligence risk. So yeah, as Scott said, a lot of the money is just going to the top. But even at that point, you'd think that, okay, if the top has to just invest in some basic stuff and they are the market, then at least they could do a little bit better than the market. I'm always surprised to see pretty much every risk parity portfolio as far back in time as I can look that's publicly available. I don't know about the private funds, but all the guys with mutual funds, et cetera, their benchmark is 60-40 bonds equities. That's essentially what they're trying to beat. They've all dramatically underperformed it over 3 years, 5 years, 10 years. If you look at the fund-to-fund community, a lot of them have pretty strong factors to most basic factors, equity factor, bond factor, often trend factors, yet they're sharp one maybe. And I'm looking at, if you were just to blindly slam together stocks, bonds, and trend, you'd be much higher than sharp one. So it's kind of like, what are you doing wrong? I don't know what all the issues are, but yeah, I've kind of created a very, I shouldn't say very unique. That's not proper. I've created a unique product, uncorrelated to really anything out there, that's been able to deliver alpha over the last 6 years. But being different is a double-edged sword. I've created something, but it's different. It doesn't check people's boxes. There's a risk of us as a small manager, at least that's a perceived risk. So yeah, I just think, what people like Scott are doing, and there's other people out there. Some of the large, large multi-manager kind of potted out shops have certainly figured out this idea of number of uncorrelated return streams, combine them together and create a higher sharp product. I like to say diversification is the closest thing that we have in this industry to a free lunch. So some people get it, but surprisingly, it seems like most of the industry doesn't.
Yeah.
Yeah, well, I think if I'm sorry, go ahead, Scott.
Yeah, we think there's kind of a cost and information problem for investors getting through to Max. There's a cost problem, which is, they have to go meet Max and team 10 times and do all the due diligence, and it takes them a long time to finally decide, and they never quite sure from his returns. So it's costly and slow, but it's also information. How do you find Max? And then the analytics around, is his strategy really alpha, or is it, just a lucky strategy that delivered something good over a short period? And so those sort of skills to identify that, are around, but they're not everywhere. It takes a little bit of nuance to figure that out. So there's kind of these two obstacles to try to get through to Max. And you might expect the consultants and the sort of allocators to be better at it. but they're under pressure. They're risk resource constrained and time constrained and cover your ass job security incentive constrained. So as we're sort of very consistent with Max, we think the industry really needs new thinking, some new innovative approaches to break some of this method of operating. I mean, hedge funds worked 20, 30 years ago when hedge funds used to be running hundreds of millions of dollars, right? Now they're running tens of billions of dollars, just excess returns, impossible. It used to be less efficient, so those good managers, hedge fund managers, probably had some information advantages, right? But they could deliver excess returns. There were a few of them around, and now the industry has really changed and become different. And this concept of hedge fund, the big AQR, and even he says he's not a hedge fund, right? So these big sort of hedge fund giants just can't deliver returns. So how do we open up the channel for those managers that can?
And Olivier, what are your thoughts on, right? My thoughts are, if I'm the big allocator, my issue is I understand that there's maxes out there in the world who can deliver alpha. My problem is if I pick 10 of them, if I get the wrong one, the dispersion is way bigger, right? Between the worst performing one and the best performing one, versus if I pick these large guys, the dispersion's really small. So I might not get the best, but I'm almost guaranteed not to get the worst. How do you look at that from like a quant perspective?
So for me, I mean, the issue is, again, that search for uncorrelated returns, right? So we know there are maxes out there, and the job doesn't stop at finding them. Okay, you found max, and as you say, okay, now I've got to find another max, because what I'd like is a 10 max kind of strategy to basically diversify away my key man risk. Okay, so ongoing, you have to be able to look at these guys and say, okay, is this still working or is it not working? And when I have this other strategy, the dispersion is getting big, but it's going in one direction, should I start to move together with it? So the amount of work that has to go on managing that pool of managers is also quite onerous. And if, like me, you have a full-time job, you'd like to pass that on to someone. What Scott's platform has within Noviscient is the ability to test those strategies live, ongoing, make changes to the mix dynamically, which is something I wouldn't be able to do as an individual, or by calling my account manager at the big firm who happens to be on lockdown right now, so I can't reach him. Those kinds of things. So the technology comes to my help here, because I definitely think, I don't think the entire financial services industry is broken, because we have people like Max and others out there. So finding alpha or manufacturing alpha is still working in places. I think the distribution model is definitely broken, and that's what Noviscient does, is it brings investors and the alpha generators together in one place. It's like having an entire financial services sector in your pocket, right? That's, for me, is a key aspect to it, and definitely where I think the industry is going moving forward. Everything is shrinking. Every industry, every sector, every process is shrinking thanks to technology. What Scott has done is just fast forward that, and obviously the alternative or the hedge fund type of segment, these guys are early adopters, so that's the best place to start with this kind of platform, and to try to bring investors and alpha generators together in an exchange platform and forego all the other middlemen in between.
That's a good segue into Scott explaining a little bit more of what. Say it one more time for me. Noviscient. Noviscient. So tell me one more time what Noviscient's secret sauce is, so to speak, right? Like, there's plenty of platforms out there where you could pick a menu of different hedge funds. There's plenty of fund of funds out there where they're doing the due diligence and selecting good managers. Where do you see your difference in that spectrum?
Right. Yeah. So So we're trying to, we say this, I'm not sure if people kind of get it. Sorry, I'll keep repeating it. Generally.
No worries. I'll summarize so they get it.
Okay. We're trying to bring the industry online. So we use a platform model not to help an investor find a manager, not a sort of matching platform. I think you need to have a transformation function within the platform, right? Investors don't really say, I want that fund and I want that fund. What they really want is a sort of return profile that suits what they need, right? Their existing portfolio that helps kind of complete it and add value to it. They're not looking for 7 hedge funds, they're looking for some sort of return profile. So this idea of a platform that solves some of the cost and search problems, how do we find max? Let's take counterparty risk and operational due diligence out of the picture. So instead of pushing money out where we have to do that sort of due diligence, we take signals in. So we're just thinking about a sort of signal stream rather than worrying we'll lose capital somewhere. Having a sort of real-time control in over those signals. So we run real-time risk control. So if any strategy is kind of having problems, we can shut them down instantaneously rather than a month later when I get my PDF from a hedge fund saying you lost 8%. And then we can dynamically construct. So essentially the secret sauce is the modeling that we do around Max's return streams to identify, and there's some sort of hierarchical Bayesian probabilistic modeling that tries to sort of filter out, okay, is there alpha in this strategy? If so, then we can start to allocate capital to it. How much capital? Well, it depends on the sort of objective function of the investors. So there's some modeling around trying to build the return distribution for the investor. So the kind of 2 core bits of IP which are enabled by the platform, but they are selection based on the existence of alpha and allocation, which then combines
And so it's
distributions.
And so it's a little bit opposite of or contrast that with the old school model, right? Would be to fly your analysts around the country, around the world, meeting with hedge fund managers, and they're kind of sizing them up, asking a bunch of due diligence questions that may or may not apply, and just getting a general feeling of if they quote unquote understand the strategy. And then, so there's that qualitative piece, and then there's the quantitative piece that many of those are doing. And it sounds like you're kind of saying, hey, we're going to discount that qualitative piece a little bit because a lot of it's fluff, and we're going to increase the quantitative piece tenfold and have it really be a big data driven approach.
So if there's a sort of false positive, false negative thing here, right? If you're a big allocator and you've spent the last 18 months and a few $100,000 investigating this manager, you're really
you're pot committed in poker parlance, right?
Yeah, that's right. You're in, right? So you're very scared of making a mistake because you can't really get out the day after. So you're kind of very scared of false positives. In other words, I think they're good, it turns out they're not good. But what that means is you miss a whole lot of, have this false negative problem, right? You reject a whole lot of strategies that potentially were good because you're so scared of putting out money into the wrong ones.
A lot of the solutions for a lot of guys is to not take the calls in the first place, to avoid getting pot committed, to avoid getting too involved. I just won't take those calls so I don't fall in love with the guy or girl.
Exactly. And if you're $100 million manager, and maybe you could go to 300 million, all that cost and effort is just not worth it for most consultants who are not going to make many fees from it. So even if the returns are there, the technology doesn't allow you to kind of, the economics don't allow you to do it. It's just not worth it, but it should be, right? Technology should allow you to get much more granular to filter out the really good managers.
Let's make some friends or enemies in the industry here. Consultants,
Absolutely.
pension and endowment consultants, net positive or net negative for the clients they serve? What's everybody's thoughts?
Statistically, they're flat, right? Flat to negative. There's no when they do the
The
numbers, they don't.
consistency, that's the problem. Yeah.
Yeah, they don't deliver. They're not selecting the right managers, and they're also naturally, for job reasons, predisposed to allocate because it's simpler and easy to just push your money to the very big funds, right? You keep your job, you stay in that center of distribution, right, rather than some risk that you choose the wrong fund. So they're not doing a good job, I would say. Max, what do you reckon?
Honestly, I don't know many people out there that are doing a good job. I don't know the numbers for the various kind of sectors of investments, but I mean the really good guys out there seem to be running pretty big multi-strats with a number of different strategies, a large number of managers. I just think it really comes down to diversification at the end of the day. That due diligence work is a lot. I mean, I talked to some of these large kind of multi-manager either allocated out or even internally multi-managers, and it's a lot of resources to do the due diligence and everything. But the diversification model has never been broken. Like that's really what works. And this idea of chasing big managers, chasing pedigree. This is something I hear a lot. So for some reason, I don't know why we don't qualify as having pedigree. So graduated second in my class out of 600 students at University of California in Berkeley, summa cum laude, double major mathematics, NYU, financial engineering, master's, one of the best programs. Like, I've worked at the big shops, but people like these kind of rock star names, and they come and they go pretty quickly in most cases. So yeah, I just think most people are just not very well focused on what really makes a good investment and what makes a good portfolio, and are probably underperforming. I think most people should just go back to 60-40 bonds, honestly. If they don't want to do the work on finding someone like me, just do 60-40 bonds or 50-50 or something like that, and don't touch it. Just let it sit there. It will grow eventually.
I would argue that diversification has broken many times, right? It was diversified between 30 stocks in the Dow, you're fine, and then diversify between growth and value, then diversify into foreign, then bonds, then foreign, right? So like every time they get although 60-40's hung around for a pretty long time, this might be the final straw on 60-40 with bonds at the zero bound here.
Yeah, I mean, it certainly has a risk. And I mean, I'm just kind of saying 60-40 as, an example of something that's been around forever and anybody could essentially implement in a very low fee, buy the Barclays aggregate ETF and the S&P ETF and call it a day. You want to get more diversified and diversify across regions, geos. That's one thing. You could obviously now get pretty low fee trend products too, which I don't believe is a crisis alpha, but it is an uncorrelated alpha. It's struggled for many years, but it's uncorrelated, and you throw that together, you have a kind of third uncorrelated piece to the story, and then maybe eventually you start getting into some other things that are not as broadly known to the regular investment community. But I mean, yes, anything that you say probably eventually will be proved wrong in this world and in finance.
Yeah.
So I'm not saying it's bulletproof, but it seems to work a lot better than everything else I see going on out there. I'm all for keep it simple, stupid.
Keep it simple. And then I would also argue that as we noted, there's $3 trillion of investor bets on hedge funds that do believe in their diversifying powers and that aren't turned off on it, right? Like we've kind of made it, or not you guys, but I've kind of made it sound like investors are flooding out of the space in mass, but quite the contrary. They're holding in there quite a bit.
But it's all about, for me, knowing that I have transparency into my personal investments. So Scott will show me how my fund is doing daily. I can get out of it, when I want. He is also able to, through the platform, If Max has a bad day, decide that like we're going to drop that for the next few days or something until he gets it back, and so on and so forth. So that kind of dynamic process, which I would not be able to do, A, by myself, and B, even if I was able to call Max and he has something like a monthly liquidity, it wouldn't help. I would probably be getting out at the wrong time. Whereas through Noviscient, I can, get out instantly. And actually, I don't have to get out instantly. Scott does that for me. So I like that.
Yeah, and I think kind of in my mind around all this is the concept of a narrative, right? Like too much of the industry is narrative based. The monthly, the quarterly hedge fund letters that are either outright making up stories for why they did this or the market did that, or worse, maybe that they actually believe what they're writing. So it kind of seems we're saying this Noviscient can kind of cut through all the narrative BS and just help you understand the true return and risk profile and make sure you're comfortable with that and then deliver that for you.
Yeah, and the transparency that comes with it.
Yeah.
Yeah. I mean, there's people make decisions on stories or data, right? And
Right.
Max and we are trying to shift that towards the data side and away from the story side, because the stories are often these sort of ex post rationalizations of some gut decision that you made, that lacks a lot of objectivity and is quite biased. So we want to scientific the industry.
Yeah. And the world's hurtling towards that in every endeavor, right? Like my father-in-law will still be like, okay, if you're getting over to that side of town, go down this road over to here, turn left there. And I'm like, there's an app for that. It'll tell me exactly the time and which roads to go on. And he's like, yeah, but that's just guessing, right? And I'm like, no, it actually pulls in real-time data from all sorts of different sources and tells you the traffic. And he's like, no, that can't be. So we're still a little far ways off, but right, I think the more quantity you are, the younger you are, you kind of get this of, hey, the world is moving towards algorithmic decision making, and this should be no different. You shouldn't base your investment decisions on Bob's recommendation or some other narrative based item.
Yeah. So you bring up a good point. The fact is, quants have been around now for 20 years. So 20 years ago, they moved to, data-driven decision making. But what we're seeing today is exactly what you described. It's real-time data decision making. Instead of, I got the annual reports from these guys. I got the quarterly reports. I'll crunch the numbers and get some alpha. That's what, BGI and other people, places like that did in the earlier part of this century. But now everything is moving, real time, online, and in my hand, in my mobile. Why do I have to go to a computer to find out about my investments? Why do I have to, if I had to print out a map from my computer to drive to that place, that, nobody does that today. People take their phone with them, and the app is with them, the map is with them, and you can even see your car move real time. And they'll give you changes. So that's where we are right now. But the financial industry or the investment industry is still, a couple of possibly decades behind that, and that's what we're trying to bring it in.
Right, except for the world of Robinhood and a lot of those, there are apps and tools that have bridged that gap and are giving real time. But yeah, I would agree. For the most part, institutional investing is for sure not real time. Yeah. A year lag at best. What about the dangers to that, right? Of like knee-jerk reactions, too much information overload, right? It's joked that private equity does so well because people can't get out, right? If you did that for a lot of other investment strategies, they would probably perform a lot better.
Yeah, I mean that's a risk, but it's there. But that's what diversification is about, right? So you have multiple guys who have short-term signals, but you also have some maybe medium-term signals along as well. So you diversify not just across strategies, but across investment horizon as well, and that gives you some clarity about that. Right? The knee-jerk reactions, again, that's where technology comes in, and applying machine learning to whether Max's performance was skill or luck. And if there's skill there, then you stick with it. If it was luck, then obviously you get out once the luck runs out, because that's random. It becomes a random signal. But and that's where, not just getting real-time data, real-time information, and the expertise that people like Max have on the supply and demand within their specific investment universe, but also machine learning techniques to find out what's what.
Okay. Worthwhile, just this other quick idea, right? Newer managers, more sophisticated, more, perhaps ML-driven managers eventually are finding it harder to raise capital because the allocators just don't know what the hell is going on.
Because there's no narrative.
There's no narrative. That's right. That's right.
Yeah.
They can't tell a story about their stock picking. They haven't got a sort of 3 to 5 year track record. So it's scary to invest in them. They don't really understand what the hell is going on. For us, we think we're a natural partner for these guys because we can bring them on pretty light and quickly. We bring them into a diversified pool, so, with tight risk control, so investors are not exposed to their investment into that machine learning strategy just going wrong and making them look silly. And also because we can be a bit dynamic and moving them in and out, we can, help them slowly build and grow, to a certain extent. They're our sort of heroes, right? They're the ones we're trying to make successful so that we can be successful. And we think, we're a natural partner for these more high-end strategies to get access to the bigger pools of capital eventually.
I told a AI-driven shop once that they should create an AI model to create a narrative so that they could say, here's why we did what we did this month. That was all AI-driven too, but right, fit it to the data.
Yeah, it's a good idea.
Because they do have that problem. What do you do when CalPERS goes, why did we lose 4% last month? And they just point to the black box and say, I don't know, the box lost it. Like that I think is untenable in this day and age for now.
It also seems like that maybe one of the bigger issues is, beyond not having a narrative, is that the term has just become so hyped.
Yeah.
Look, at the end of the day, machine learning is the future, I believe, whether you want to call it AI, machine learning. In a lot of cases, people are just doing statistics, but your output is only as good as your inputs. So in Scott's case, if he had 100 not very good managers, his machine learning would say that they're not very good managers. And if he invested with them in the best portfolio optimization ever, it still would be a not so good portfolio because it was bad inputs, bad managers. And in the case of managers themselves using it, I'm sure that there's some people that are doing some pretty cutting edge stuff. I think most of those people probably we don't hear about, or you don't have access to, but the majority are putting in the same old inputs that they were already looking at. The CTA spaces, they're putting in technical features. So you put features into a machine learning model. If you put in a bunch of technical features, some of the things that machine learning does, like picks up discontinuities and nonlinearities and things like that you wouldn't maybe discover from a basic regression. Some of that may help you out a little bit, but at the end of the day, you're still using the same technical features to make an investment decision. So they're important processes, they're helpful, but unless you come up with a novel idea or a novel data source, you're just going to get the same old thing out. And that's what a lot of people that I see on the manager side that claim machine learning are doing. So I think it's just turned people off, is that they're really not delivering. And maybe lastly, a lot of the people who seem to be doing something more substantial, they had a pretty good story about their abilities. They just went through a period of this compression trade and just this rising equity market. And depending on what your look back period is the model is just going to pick up that movement after a certain point. So you saw a lot of the really, the guys that were more recognized for their machine learning skills in March just completely fall apart because they just been lulled into the beta trade
by the dip. Yeah. Well, they probably made it all back now by the momentum.
Yeah, or by the Fed.
Right. All right, we're gonna wrap it up in a little bit and go on to some of your guys' favorites as we end every pod. Any last thoughts on Noviscient or how you guys are involved before we move on?
I think it's worthwhile just quickly pointing out, I think Max is absolutely right. If you say, how are you going to generate excess returns, there's sort of three things we think you need. You need you need domain product market knowledge. You need to understand the domain that you're sort of operating in. There's just a lot of people who kind of wander in and do not. You need increasingly technical skills, the ability to use computers to build better models that make better decisions. And then you need the magic bit, right? The sort of differentiation, whether that's a different set of data or just a really unique way of thinking about how this market is operating. So this combination of a sort of differentiated approach / data set plus technical skills plus product market domain knowledge. That's our experiences. Those are the three necessary conditions to deliver excess returns, and many managers, are missing one or more of those.
And that you're going to deliver that. And then I was going to ask you, of what does success look like for Noviscient in terms of assets, in terms of performance? Is there a benchmark for either?
Yeah, sure. So we with this diversification, we can take strategies that with sharps of one-ish, so there's some alpha there, there's some excess return, and build products that are delivering 20+% returns, sharps of 2 to 3, not because the underlyings are very scary and high sharp, just because the mechanics of bringing uncorrelated excess returns together allows you to deliver great products. So the growth story is really we're hitting family offices now, growing through them at the moment. We've spoken to a lot of very large institutions from, Australia's Future Fund to AIG to the big Northern European pension funds. And they are sort of saying that is very interesting. You need to get to a sort of scale. So we continue to keep them updated, and ideally we're starting to hit the endowment funds and some of the interesting pension funds, in small testing outsize next year, but really we want to revolutionize, change, bring this whole, at least the alpha part, online. So that's a $500 billion sort of space that can probably grow because there's more inefficiencies with people just can't find them at the moment. So $50 million by the end of the year, and a couple of billion after that onwards. There we are for you, Max.
Great.
I'm looking forward to it, Scott.
All right, let's end up with some of our favorites. Max, you're a big foodie, I hear. What's one of your favorite New York restaurants?
Oh,
If
I
that
love
one's
Tomo.
too tough, I'll take
Tomo for sushi. It's in kind of Greenwich Village, West Village. It's a hole in the wall, but it's been there for 25 years, and he gets the best fish ever, and it's reasonably priced.
All right, I'll take it. And Scott, we didn't even touch on this, but you're a big skier.
Right, not so much in Singapore. We wander off to Japan or to Europe a little bit, but I did spend after I was an engineer, and then I decided to go ski instructing for about 3 years. So I spent 3 years in Austria.
Austria, wow.
Sitting up on the mountains.
Hermann Maier, what was the Austrian legend?
Yeah. He was Hermann
Is that
Maier,
him?
yep, exactly.
So what's your favorite ski spot?
I skied all the time in this place, Zellamsee, in Austria. So I had a sort of a mountain. The village was just at the bottom, had a big lake, so pretty in summer and winter. And up the road was a glacier, so we could actually ski all year round if we didn't mind avoiding the crevasses and things.
It's kind of like finance.
All right, Max and I will come out to join you for a Japanese ski trip.
Yeah, we should do that.
Olivier, favorite Singaporean dish?
Oh God, Actually, I'm partial to the roti prata, which is this Indian kind of bread with curry, and you have that for breakfast here, which is weird. Nobody thinks about curry for breakfast, but here it's a big thing, and it's one of my favorite. And you can get that anywhere on the island.
And then sticking with you, what's your favorite investing book?
My favorite investing book? I don't think it's been written yet because I've read a lot of them, and every time I was like, I threw that one away because they keep writing about the past, and I need to find one that writes about the future because my money is going to go into the future. So I'm waiting for that one to be written, and hopefully Scott and I will write one at the end.
Right.
Yeah, exactly.
The story, the narrative.
And then we asked everyone favorite Star Wars character. We'll start with you, Scott.
Obi-Wan Kenobi. He's
Obi-Wan Kenobi.
Yeah.
Perfect.
Like him.
The master.
The master.
The Max, how about you?
I had to think about that one. Salacious B. Crumb.
Salacious Crumb, yeah, the little guy on Jabba the Hutt's shoulder.
I laugh a lot. I've been trying to spare you guys with my incessant giggle for the podcast, but I laugh a lot, so his giggling kind of gets me.
I went to the new Disney Star Wars Land late last year before the Corona or whatnot. You can buy the doll of that little guy in the new land. So next time I'm there, I'll pick one up for you.
Nice.
And then Olivier, are you a fan of the movies? Do you have a favorite?
Yeah. I mean, I would have to say, I prefer the machines than the actors. So I would say the Millennium Falcon is my favorite part of that movie. It's all beaten up and it keeps getting shot at, but it's still there and it still carries them through. If you force me to pick up a character, then I'll say R2D2 because he can fly, he can ride, he can sing, laugh, play videos, and he's data driven.
Just plug into any computer and decrypt it in seconds.
That's right.
He's the man. All right, guys, well, this has been fun. Thanks so much, and best of luck with Noviscient and what you guys are doing.
Thanks
for the time. This has been fun.
All right, we'll talk to you soon.
All right, take care, everybody.
Listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you.